Hey, everybody, welcome to the April 2026 market update. Going to jump right in, got some good information to share for this month. As always, we are looking at the 5 county area, which includes Wake, Durham, Johnston, Orange, and Chatham counties. More good news this month. New listings were up 13%, a little bit under 4,500 new listings hitting the market. Last year, there were less than 4,000. So we had about 500 more listings hitting the market in April of this year. Year to date, we're up 9.1%. With just over 14,000 listings for the year, 14,289. This is important. We've needed more listings coming on the market. We've had a drought of listings for the last several years. So we're finally starting to catch back up. I'll show you charts in just a few minutes. They kind of give you some visual perspective of the progress that we're making. But closed sales were also up. So this is important. We don't want new listings to be going up and closed sales to be going down. That's going to be a recipe for an inventory issue in the future. But as we see new listings going up, closed sales going up almost 11% in April, that's a fantastic number. And year to date, we're up 2.4%. Again, you'll see in a second, but we have finally surpassed last year's numbers year to date. So that's really exciting. Almost 8,000 closings through the first 4 months of the year in this area. Median sales price was up barely, just 0.2% at 455,000. Year to date, we're down almost 1% at 440. That's actually really good. As you've heard me talk about, we need pricing to remain relatively flat. So to be up 1% or down 1%, as we get towards the end of this year, if those are our year-to-date figures, that'll be a really good place for us to be. That's going to help manage affordability, set us up with a nice foundation to grow from there in years to come. So list price received 99%. So there's still some negotiating room out there. Anything 98, 99%. That's pretty healthy. Total showings also up 12%. So this is fantastic. New pending sales up almost 13%. So you look at this, new listings up 13%, total showings up 12%, new pending sales up almost 13%. It's not probably a coincidence that these things are aligned. We put more listings on the market. They have more, the buyers have more to go look at, and they ultimately put more under contract. So this tells me that the available buyer pool is sufficient to continue to eat up new listings as they come on the market. So these are all really good signs moving forward. Now, keep in mind, this is April. So there, what is more macroeconomic stuff happening that is currently happening, the conflict in Iran, oil prices, inflation. So those are things we'll look at and talk more about in just a few minutes. Inventory up 15.3%. Again, very good, very normal. We've been trying to catch up on inventory for a long time, and really kind of a milestone number here that I'll talk about in just a second. But you can see we have about 1,000 more listings on the market in April than we did of April of last year. 3-month supply of inventory. Now, what I mentioned in terms of a kind of a milestone number here for inventory is that when we look back at April 2019, so as you know, I like to look back at 2019 numbers to see how we stack up to the most recent pre-COVID market. COVID disrupted the market in a really significant way that we are still seeing 7 years later, or 6 years later, I should say, from the onset of COVID. And we are starting to find some renewed normalcy or equilibrium in the market. But that is a process, not an event. But when you look at inventory levels, 7,795 back in April of 2019, and we were just about 40 homes short of inventory. So for all intents and purposes, equal to where we were back in 2019. But again, for those of you who were selling real estate back in 2019, it felt like we had no inventory back then. So still plenty of room to run here in terms of having enough inventory for a healthy market so that everybody that wants to buy a house can find a house to buy. Right now, that's still not the case. There are buyers out there and the right homes just aren't available for them. The best homes are selling, the lower positioned homes maybe are sitting longer, but we need more quality inventory for the buyers to find housing. Month supply of inventory back then was 2.5 months. So I just want to point this out real quick, a little nuance here. Inventory was about the same, and yet you can see we have more housing, our supply of inventory today than we did in 2019. But the way I want you to think about that is that when you're looking at month supply of inventory, you're using historical data to predict future activity. So what this means is if no more listings came on the market today, it would take 3 months for the buyers to consume that available inventory. Okay, at the rate that is based on the rate at which buyers were buying homes in the previous, let's call it 6 months. So you can imagine that in 2019, there was increased buying activity in the 6 months leading up to April 2019. So that means that based on that historical data back then, it would only take 2.5 months to consume this inventory. Today, we are basing numbers that include a lot of the fourth quarter of last year where the market was moving much more slowly. So that data is getting thrust into the prediction of how long it would take to eat up the current inventory. So even though the inventory, the whole number is pretty similar, very close, that's why there's a slight difference in month supply of inventory. The hope, this isn't backed by data necessarily because we don't, this is a forward-looking metric, but the hope is that it would actually take less time, that the market is actually heating up, not to say heating up, but that the market, the available buyers are ready to engage with the real estate market, and they are becoming more active. That shows with showing activity, that shows with pending sales activity. And that growth can continue because new listing inventory is going up, new listings hitting the market. So I know that's a lot that I just threw at you there, but in case you were wondering why the month supply is different, just remember that's looking at historical data to predict future behavior. Let's look at the median sale price was just under $300,000 back in April 2019. If we apply what I'm calling a normal appreciation for this 5-county area at 5.5%, that would have landed us today at $431,000. You can see we're at $455,000, not far off. But if you apply this one more year, so if in April of 2027, we are looking here and prices have stayed flat in 2026, that means the pricing will have caught up to what it would have been had we never seen the COVID spike. That is really important because already anecdotally right now, it appears that consumers are agreeing with the value that they get at a certain priced home. Meaning, if you look at a house that's priced at $500,000, most consumers are looking at that and saying, yeah, that feels like a $500,000 house. That will become even more so the case next year if prices, in fact, stay mostly flat this year. So that's, again, another exciting thing. I've been doing these videos for years, and we've been waiting for the day. I've been telling you for several years, we need prices to stay flat, and the market listened to me. The prices have stayed pretty much flat over the last several years. And the market has caught back up to where it would have been. So that's a really important kind of nuance to building a healthy foundation to allow the real estate market to grow in the years to come. New listings back in 2019, 4,090. Year to date, 14,250. Another benchmark number, because let's look at the year to date new listings for this year, 14,289. 14,250. We have officially surpassed where we were back in 2019. Now, where we haven't surpassed is in closed sales, but we do need those new listings hitting the market in order for buyers to have homes to look at, in order for them to go pending and then eventually close. So that is a great first step and forward-looking metric. But closed sales, 3,108. As you can see, this year we were at 2,615. And year to date, we were at over 9,800 back in 2019 and just under 8,000. So we're still behind the 8 ball here in terms of number of closings, but we are moving in the right direction. Pending sales back in 2019, just under 3,400. So we're about 10% short. You can see right here, we were at just over 3,000 this April. So a little more than 10% short of where we were back then. But again, as long as we're moving in the right direction, that's what we've been wanting to see for the last several years. And we've seen a lot of concrete data this year to show that that is happening. So hopefully there are no more macroeconomic situations that are going to cause this to reverse trend. We'll talk about affordability here at the end because that is something that we need to watch. So just to give you kind of some graphic visualization here, this is inventory levels. Now this is good. As you can see, we've basically caught up to 2019. Now, the question as we get into May and June and July and into summer is we want to see this green line flatten out up here. If it flattens out above the blue line, that's fine. That's no problem. If it's below it, that's okay. We want to see inventory go up. But what we don't want to see is this green line continuing to go up throughout the summer. that will likely cause an issue because closings will inevitably start to slow down. We don't want to see inventory levels climbing really through the summer months very much. We want it to be this kind of flat line over before starting to really fall off a cliff in November and December. That is a normal and healthy trend that we want to see. So we will monitor this as we get into the next couple of months, and hopefully, I don't see any reason to expect differently. This should start to flatline as we get into May, June, and into the heat of summer. Looking at new listings, this is year-to-date numbers, and you can see here we started the year below. So the green line is this year. We started the year below the orange bar, which is 2025, but pretty quickly we were able to overcome that in February and have continued that trend and have just surpassed barely 2019 levels. So again, hopefully we'll see that trend continue and see the green bar above the blue bar. That's what we need in order to have enough inventory for our market to remain healthy. As we look at closed sales, this is just monthly figures. Again, in January, we were below that. If you remember the January video I talked about, that was kind of a surprise hit to see that closed sales were below last year's numbers. They were still below in February, but not as much. And then beginning with March and continuing in this month in April, we have surpassed 2025 numbers. And if we look at year to date, you can see it was actually this month in April that we, from a year to date perspective, surpassed 2025. So slow start to the year, but in March and April, we really came on strong and hoping to see those trends continue. We're still a long ways from overtaking 2019 numbers. But again, I cannot stress it enough that us moving in the right direction is just what is so critically important. We're not going to bridge the 1 million or 2 million national gap that we have and expect for closings overnight, but making steps in the right direction is what we're hoping for. And then looking at pending sales here again, historically you see a small drop off in April from March. So you see a big run up in March in our market anyway, a little bit of a drop off in April. And then the hope is we see a little bit of a rebound in May. So again, we'll watch this. Nothing to be really concerned about here. I would expect a pretty similar trend line as we get through the year. All right, so one of the kind of custom things I like to look at is this new listings to closings ratio. And what this tells you is what does it feel like to be a seller out there? Not so much what are buyers feeling, how they are interacting with the market, but it tells you the level of pain that a seller might be feeling. We're actually moving slowly down, probably a little bit slower than I would have expected. But what's happening is we had such a slow start to the year in terms of closings. That really got us behind the 8 ball in terms of where this ratio is likely to end for the year. To start the year, I expected we'd be somewhere around the same as 2025. That still may be the case if we see closings continue to match the pace of new listings. Then I think we can get there. So a lot to be determined here. This number will typically continue to go down throughout the year. But the way I want you to think about this is it takes about 18 homes, technically 17.8, but we don't sell 0.8 of a home. So we'll call it 18 homes. You have to list 18 homes in order to sell 10. So that tells you that 8 of those sellers are unhappy. Almost half, right? 8 out of 10, or 8 out of 18 rather, did not end that process happy because they listed their home, it didn't sell. So this isn't exactly the way, because we have to look at this from an entire year's perspective to really get the data to match up, because you have listings being taken in January that weren't going to close until later. So just take my word for it. This number will likely continue to go down. But again, you look back at 2011 at 1.54, still pretty tough as a seller back then. So, if we're ending the year at that 1.5 range, it's just going to tell you that pricing is really important. So take note, listing agents, you've got to have honest, open, transparent, and hard conversations with your sellers. You can't just price it based on what the data from 90 or 180 days ago told you. You're going to probably have to be a little bit more aggressive because more homes are sitting and not selling right now. This one data point tells you that. And then we get into housing affordability. So came down a little bit in April. We are at 89. Remember, 100 represents that the median household earns enough money to afford the median priced home. Right now, it's saying that the homes are making 89%. The median home is making 89% of what they need to afford the median priced home. So we really want to see this go back over 100. We haven't been over 100 since March of 2022. But just to give you a visual here of what housing affordability has done, this goes back to January 2019. Again, we have these just amazing metrics. What a beautiful time it was to buy real estate in the triangle. But unfortunately, as COVID really ramped up, prices were skyrocketing, mortgage rates were getting ready to start going up, wage growth was not keeping up, and home affordability plummeted. We saw it just bounce around here in the 70s for a while. We saw a run up starting in the fourth quarter of last year. And then now the last couple of months, we've seen it start to drop again. This isn't anything to panic about yet, but this is clearly something to watch. So there's a lot of good data in this report. This is the one thing I would say we really need to watch because this is based on April. However, the May data has come out in terms of inflation and wage growth. And for the first time in quite a while, inflation surpassed wage growth in the May report. So it is certainly possible that the May home affordability index is going to continue the trend that we're seeing down right here. Of course, we hope to see things like the end of the conflict or resolution to the conflict in Iran. Hopefully oil prices coming down. We'd love to see mortgage rates continue to moderate and get down more to that 6% or under range, and then wage growth continue to grow. All of that will hopefully help moderate inflation, but that's yet to be seen. So just be prepared that the housing affordability may suffer again come May. The good news is that right now, all the pending activity, the showings, the pending sales, that is all still trending really strongly in the right direction in light of or in the face of some of these headwinds that we're experiencing from a macroeconomic perspective. So all stuff to continue to watch, but right now data pointing that the market is still performing really well, which is fantastic. I'll continue to monitor this and I'll be back next month with your May report. Thanks as always for listening and talk to you soon.